So I finished writing my thoughts about Vulcan Energy Resources raising $100 million, and then the news of Gina Rinehart and significant investment provided by BNP Energy Transition Fund broke out. Instead of raising for 100 million, Vulcan got 120 million at $6.50 per share. And as of recording this video, Vulcan Energy Resources is already up 18 to 19%. So let's talk about their capital raise, what they're using that money for, the economics behind the pre-feasibility study, and the impact of Gina Rinehart and BNP Energy Transition Fund investing in this capital raise. As usual, this video is not financial advice or recommendation for you to do anything. It's just general information for entertainment purposes. So without further ado, let's go! Before I start, no, I'm not sponsored to make this video, and no, I also don't have a position in this company. I've already made a deep dive video on Vulcan and why I'm interested in the EU market more than other markets. So I left the link to those videos in the description box below. Feel free to check out those videos after this one. Let's do a quick overview of the problem Vulcan is trying to solve and their value proposition. There are three major trends that have created a massive opportunity for Vulcan. First, the demand for EVs are going to be massive in the future. And because of that, the demand for lithium will also grow along with it. Now, secondly, the pandemic have shined a light on the over-reliance of materials coming from China, not to mention the high carbon footprint that comes with these materials as well. So the automakers and battery manufacturers are looking for ways to de-risk their reliance on China for materials. So they're looking for supply closer to their continent to both capture GDP and also lower their carbon footprint. And thirdly, outside of China, Europe is actually the fastest growing EV market. So to capitalize on the lithium opportunity in Europe, Vulcan's solution is a zero carbon lithium produced from a geothermal project in Germany. So in simple terms, the lithium-rich brine is pumped to the surface and the heat is used to power the facility or sold back to the grid as an additional form of revenue. And then the lithium will be extracted from the brine, refined into a battery-grade material, and then the brine without the lithium will be pumped back into the reservoir. This entire process is powered mostly by renewable energy, hence the term zero carbon lithium. As it stands, it seems like Vulcan have the biggest lithium resource in Europe with 15.85 megatons of lithium carbonate equivalent. Now, that amount is literally double the amount that European metals have, and supposedly they have the biggest lithium hard rock project in Europe. Since I've made my previous video on Vulcan, they've also released their pre-feasibility study. So I'm going to go through the economics behind the pre-feasibility study before I comment on the capital raise. Now, taking a look at their project economics, the capex, at least for the first phase, is about 473 million euros. Second phase is about 700 million, and altogether is about 1.1 billion euros of capital expenditure. Now, that's a lot of euros. But I think because of their strategic location in Germany, not to mention they have financial support from EU, I don't think they have a lot of problems raising capital to get through the first phase of capex. Once Vulcan passes phase 1, there's a lot of options on how they want to fund phase 2 capex. They can use cash flow from the projects to fund the phase 2 capex, or they can raise additional capital. With their operating expenditure comparison, I was pretty blown away that their process is so different compared to the other two processes in terms of costs. Now, Infinity Lithium, which owns the second largest lithium hard rock project in Europe, can produce lithium hydroxide at approximately $5,400 per ton. And European Metals can produce lithium hydroxide at approximately $4,800 per ton. Both of these costs are not taking into account credits. Now, comparing the hard rock projects I just mentioned, the operating expenditure per ton of lithium hydroxide looks a little high on this end, but US dollars was quite strong back in 2019, so it might actually be closer to $6,000 per ton of lithium hydroxide, but this number is quite high. When it comes to the brine process, Vulcan is using Orocobre's numbers, and Orocobre is another lithium producer in Australia. And if we take a look at Vulcan's operating expenditure numbers, they're essentially saying that it costs them half, well, actually less than half of what it takes to produce lithium hydroxide from hard rocks, or close to half when it comes to the traditional brine process. What Vulcan ultimately is trying to say in their investor presentation for the capital raise is that because of the low cost input that's going into the process, not to mention their entire process is powered by renewable energy, and compounding that with direct lithium extraction, they have the potential to produce lithium hydroxide at a very low cost. But the thing that worried me the most about the Vulcan project is that according to Albemarle, which is one of the biggest lithium producers in the world, they have said that Australian hard rock projects, which is spodumene, on average takes about 4 years to fully come online. Whereas the brine projects, as you can see here, takes quite a while to come fully online. According to the Vulcan project timeline, they're essentially saying that the phase 1 of the project will come online in Q2 2024. We're in Q1 at the moment of 2021, so they're saying that it's going to take them about 3.5 years for the phase 1 to come online. If you're an engineer working in this field, can you please let me know in the comment section below whether these timelines are actually realistic? And maybe because this is a geothermal project, the time it takes for the production to come online is much faster. On a separate note, what I think is really interesting is that by the time Vulcan fully come online, during this period, it's projected that the global lithium market will be in a deficit. So the automakers and battery manufacturers might be willing or more than willing to pay a premium for that material. At the same time, I think that battery manufacturers and automakers are aware of this issue, and they should be locking in supply contracts now to deal with the future supply constraints, not to mention the crazy price fluctuations if lithium does go into a deficit in 2024 and beyond. In total, Vulcan's looking to raise $100 million. $50 million will be going into project development, feasibility study and overheads. 30 will be going to drill site acquisition, and then 20 million will be strategic opportunities and accelerating project development. At this point, I really don't think Vulcan have any issues raising capital. Institutions are probably snatching up as much as they can right now. And today it was announced that Vulcan Energy, instead of 100 million, they got 120 million with a cornerstone investment coming from Gina Reinhardt's Hancock Prospecting and significant investment coming from BNP's Energy Transition Fund. With that kind of backing, I don't think they'll have any problem raising capital through phase 1, as long as they deliver on their project timeline. But Vulcan is not getting that $120 million for free. In exchange for the $120 million, according to their most recent ASX announcement, the maximum amount of shares they're looking to issue is about 18 million shares. And that 18 million shares will have an issue price of $6.50, representing about a 17% discount before Vulcan went into trading halt. Bear in mind that one of the big reasons why Vulcan Energy Resources is trading at such a high share price is because before it went into trading halt, the number of shares outstanding is actually quite small compared to some of the other companies. Normally speaking, the directors in the company are very well aware of the impact of share dilution. They wouldn't necessarily do it unless they know that by raising capital, this will substantially improve the business. That being said, I have two different views on the share dilution impact. With the share dilution impact, if I don't take into account the options, performance rights, the share dilution impact after the raise is actually pretty small, given that the market cap stays the same. In one of their earlier investor presentations, they have actually shown the amount of options, performance rights, milestone shares available. So if I take a different view and add all of those up into the total shares outstanding, taking into account the capital raise, the diluted share price impact is actually very different. Whether you choose to acknowledge the options and performance rights, that's up to you. But with smaller companies, I tend to pay a little bit more attention. At the same time, the capital raise clearly indicated that it generated way more value than the share dilution impact. All in all, even though I don't have a position in this company, and
shame on me,
I'm incredibly happy to see this project come into fruition because we need all the resources and talent we can get to solve this climate challenge. So thank you so much for watching this video all the way to the end. I'm about to lose my voice, and if you do want to support the channel, not to mention be part of my fortnightly Q&A and additional content pieces, consider supporting the channel via Patreon. Nevertheless, if you have learned something new, consider gently smacking that like button right there. Subscribe to my channel so that when I release future videos, you'll be the first one to know. Until next time, my name is David. Otto will always do the honors, and see you very, very soon.